What's up, world? It's your boy Ross Mack of Macconomics, and yeah, let's talk about it. A call option is a contract that gives the owner the right, but not the obligation, to buy a specific underlying stock at a predetermined price, known as the strike price, within a certain time frame, which is the expiration date. Now, for every option, there's a buyer and a seller. Let me break it down more. When you buy a call option, you're buying the right to purchase from the seller of that option, usually 100 shares of that particular stock at a predetermined price, known as the strike price. You have to exercise your call by a certain date or it expires. To purchase a call option, you pay the seller of that call a fee known as the premium. When you hold a call option, you hope the market price of the stock associated with it will increase in the near future. Why? If the stock price increases enough to exceed the strike price, you can exercise your call and buy the stock from the call seller at the strike price, or in other words, at the price below the stock's market value. Yes, you can purchase a stock at a discount. When the current market price of the stock is higher than the strike price, the option is in the money. Then you can either keep your shares, which you obtain at a bargain price, or sell them for a profit. But what happens if the price of the stock goes down rather than up? Well, you let the call option expire and your loss is only limited to the cost of the premium that you paid. Here, the option is considered out of the money when the market price is less than the strike price. Generally speaking, the buyer of call options believes the price of the stock is going to increase in value, while the seller believes the stock will either stay the same or decrease. Now, on the other side of the trade, there is a call seller. Call sellers, also called option writers, have the obligation to sell the underlying stock at the strike price and have a short call position. Call sellers collect a premium up front for the obligation to sell their shares to the option buyer. If the call seller owns the underlying stock, it's considered a covered call because they can deliver the shares if the buyer exercises the option, rather than going out and buying them in the open market at an unfavorable price. Covered calls can limit the seller's upside potential in that the seller generally doesn't anticipate a big price change. Covered calls can also limit the seller's downside potential for the same reason. A covered call is considered a long position because the seller actually holds the underlying shares and can cover the option when exercised. An uncovered call or naked option is when the seller does not own the shares corresponding to the option being sold. Now, call sellers prefer an option to expire out of the money because they can collect the full premium, but don't have to deliver the shares. The call seller might still see a profit if the option is in the money because they still collect the fee per share, but it depends on what the actual strike price is.